We're seeing the lowest rates. Here we are on August 5th, 2025. And Friday, August 1st, we saw a pretty good dip. We're seeing the lowest rates that we've seen since September of last year. So, hopefully some good news on the horizon. That's great for everybody so far.
Hello, everybody. Welcome to Mortgage Minute. My name is Matt Thomas. I am a local real estate agent, and I'm with Brian Dewald. He is a longtime local mortgage lender, and we would like to touch on some things here today that have been brewing in the news, some things that are changing rates finally. We've seen a lot of dead rate scenarios this summer with the rate not moving much. But Brian, in the last day or two, we've had some really, really good news and some things that are shaping maybe a path forward for us that should be promising, I hope.
Yeah, gosh, I hope so. We're seeing the lowest rates. Here we are on August 5th, 2025. And Friday, August 1st, we saw a pretty good dip. We're seeing the lowest rates that we've seen since September of last year. So, hopefully some good news on the horizon. That's great for everybody so far. So,
yeah, without a doubt. The rates have been basically stagnant for several months, more or less. We've seen, you and I have worked with several buyers that are just, we haven't seen enough fluctuation for that to matter the day that they lock in or not, right? So, but as of now, when we see the rates dip to, I want to say right about 6.5, that's sort of the going rate at the moment. They've been a lot closer to 7. Brian, what brought those down? I know there was several things going on in the economy that made those changes.
Yeah, so the big news that came out on Friday, that was the big dip that we saw. I think at one point I saw close to 70 or 80 basis points improved by the end of the day, which is a huge number. The mortgage rates are very sensitive. The two most important pieces of data when it comes to what mortgage rates are doing, or mortgage prices even, if you will, really the two biggest factors are employment data and inflation data. And on Friday, just of last week, we saw the report for July's employment figures, and the anticipated number. This is key because the anticipated number with the actual number always play into these figures. But when we fall short of the anticipated number, things always are good news for the mortgage world, right? So the anticipated figure was 133,000, and I believe that number was somewhere in the 70s, maybe 75, somewhere in there, 77. So since it came in that much lower than the expected number, the bond market rallies, and that's why we get better rates. So that's what we saw.
About new job creation, is that right?
Yeah, and what's interesting too, and I think the bond market actually goes into this a little bit. A lot of those jobs that were created in July, the vast majority of them were healthcare workers, right? And when the nerds that decide what mortgage bonds are going to do look at that, there's not really anything in there to move the needle from a financial industry standpoint, right? Like healthcare workers, a whole bunch of healthcare workers don't combine to push investments and things like that. It's just not a big, sexy number that anybody cares about from a financial number perspective.
Sure. Well, and again, as you mentioned, it's a lot less than was anticipated, and it seems like it's that anticipation that everyone kind of makes that makes the market move, and how far off of what's anticipated things are. So, when it comes to the unemployment number, it looked like that was also lower than expected, right? Or it was low. My apologies. It was higher. It was higher than expected.
Right. Yeah. So that just shows that there's, the job market isn't nearly as hot as most, I don't know what to call them. The experts seem to think it is, right? And, kind of going back a couple of months, let me touch on a couple more stats. In early July, and in early June, we get the, early August, in early August, we got the employment data for July. In early July, we get it for June, and in early June, we get it for May. And here's something really interesting, and this unfortunately doesn't have much of an impact this much later, but in in July, we saw a huge spike in interest rates because all of these jobs came out. Same thing in June. The worst 2 days in the last 6 months in the mortgage market were the 2 days that those reports came out. Fudged the number by roughly 170,000 on average. So I wrote a couple things down here. In June, there was 144,000 on the report. And in May, I'm sorry, I've got that backwards. 147,000 in June and 144 in May. The actual numbers are 14,000 in June and 19,000 in May. I mean, it's almost 200,000 jobs they were off. And when that happens, we spike, right? Those are the two worst days in the last 6 months. And unfortunately, when this comes out, we hit this huge spike. And then they revise it, right, and come back and say, oh, sorry, we jacked this number up. It's too late. The bond market's already reacted. It's not going to go retro and fix the error that was there on the report. So anyway, it's as such, the head of the BLS, the Bureau of Labor Statistics, has since been fired. So we're crossing our fingers that we can get some accurate data coming out here. I think it'll be good news for mortgage rates, and I also think it will be good for Fed if they're going to start lowering rates here a little bit. I think this might be the news to push them to cut a little harder than they were thinking.
Yeah, that's interesting. We don't delve into politics much here, so when we talk about director of the BLS being canned, essentially fired, that comes from essentially Trump, right? And he made that decision because, we see the fudging of these numbers. It's been really impactful to our market, and it's not been good. You can imagine if you're that far off on your job consistently, you probably should be fired. Not that we're calling for anyone to be fired, but, and I know that there is some controversy as to whether or not somebody should lose their job in this situation. But really, when you get the new data, the new information that tells us that, the job creation is just not what we thought it was. It's
Exactly.
bad news for the economy, but as we've been saying for years and years now, what's bad for the economy is actually pretty good for rates.
True story. Yeah. Yeah. So I agree with you, right? This data has been so skewed. We've talked about that on this show before, right? Like it's just so skewed, and we don't understand why, nor I don't think we ever will. But the fact that that person's now been replaced, I hope that we can get just some accurate data. That way, some of these figures that we see for mortgage rates and Fed rates and everything else will start to kind of align with expectations.
And it's interesting because there seems to be new pressures. So if we have revised numbers that show direction and that the economy is moving in one direction, then we have maybe there's some dissension among the Fed governors, right? So for the first time, I think since the 90s, we saw two Fed governors vote in dissent against the way that the Fed Chair Powell voted. So we're seeing a little bit more of, hey, we're not exactly sure we like how things are going. I think that there were a couple of governors that had abstained maybe from voting. I apologize if those were the one and the same, but I believe that there were a couple that didn't even vote. So some interesting things going on. And so you get all these pressures moving a certain way. And while we're crossing our fingers that mortgage rates will come down a little bit, provide some relief, it certainly looks like there are a lot of things building in favor of that being the case.
Yeah, I agree. I was, and again, not at all political, but the president was on the news here recently and just said, we have to do something. It's so unaffordable and it's so challenging for first-time buyers to get into a place. And I agree, right? I had a conversation with my dad the other day, and we were looking at how much income he made versus the cost of the house. This is back in the 80s, of course. But it's interesting to look at, the relationship between income and sales price from a percentage standpoint. And it's crazy. Like we're just way, way over what it used to be. So interesting.
So we obviously don't want to dwell in the doom and gloom, of course.
Yeah.
The good news is that despite all that, we are still working with first-time homebuyers. We are still finding ways for them to succeed in this market. Yes, it's expensive. Yes, they're having to source down payment money from grandma and things like that and find ways to be able to overcome this challenge that they're up against. But there are people doing it. And I think I'm excited to see those who are doing it and wait to, can't wait to see the advantage that they're going to have over the people who maybe had to sit on the sidelines or decided to sit on the sidelines during this time because they're going to be ahead of the game, I think, once the rates do change. Ultimately, it comes down to the people watching are not tuning in to see us talk about these economic factors. It's really comes down to we help people buy and sell homes. And when it comes to buying homes with using a mortgage, we're having success in finding lower rates for people. How are you seeing that manifest? Because obviously we're still able to help people.
Yeah, so it's interesting when you shout out rates in the mid sixes. That's kind of the average rate. Like anybody could just go on the internet and kind of Google and figure out where rates are. You and I have had some luck, and I've had this with some other buyers where we go in hard with concessions and use those fees paid by the seller to buy the rate down. It's not uncommon to see a rate in the fives right now. So there's some really neat, things that we can do and strategize when you're working with pros like me and yourself. There's some neat things that we can do to, really help somebody, get a deal. I saw a stat recently that there's more homes listed than there has been in a long time, and fewer buyers. So there's so many more options out there for folks. Last little bit here is, I had a great conversation with somebody the other day and they said, is it a good time to buy a house? I said, I don't know when the best time to buy a house is, but it's never a bad time to own a house. So I think that's another way to look at things is just say, if it's your long-term goal to buy a house, jump in.
Yeah, and yeah, it's every situation is very unique and different.
For
So
sure.
to say that a blanket statement, it's a phenomenal time to buy a house. Well, the rates could be better, the
Sure.
affordability could be better, but
Sure.
is it still the right time? It might be the right time for a person in their life, their situation, their overall circumstances. And then when you have the conversations that we're having, and I wish that it was certainly more people. It's why we do this. We share this information so that we can help people understand that there are ways to get better rates. So that 6.5 that we just mentioned is the sort of prevailing general rate, right? But when you buy down that rate with the seller's concessions, as you mentioned, we get the seller essentially, because the seller wants to sell their house. They're
Sure.
either stuck with, do I drop my price? Do I give up some money in concessions? Well, when they do the latter, you take those concessions and can use them to help a buyer buy down their rate and get into the fives. So, it's been said, but it's really how people are finding great success in this market right now. So,
Yeah, and I'll add real
okay.
quick, and every scenario is a little bit different, but 999 times out of 1,000, from an affordability standpoint, meaning monthly payment, we come out ahead doing the concessions versus the price reduction by quite a bit, usually more than double. So in other words, if we drop the price 10 grand and the payment goes down X, if we use those same funds to buy the rate down, it usually more than doubles that saving. So like I said, every scenario is a little bit different, but that's what's kind of cool about how we operate is we can show all the figures and math and, strategize as a team, you and myself and the buyers and, whatever, parents, grandparents, right? Everybody gets involved these days. But to show that math, and it's pretty interesting when we put, pen to paper and look at those figures. So
I appreciate you spending time here going over these things. As always, we just want to open the door and have conversations with folks to see where you can find advantages in this market. Again, we are seeing people being able to get rates well into the fives. And when you take a look at somebody's specific scenario and then you say, could we get you concessions to buy down these rates? And by the way, the rates that we're talking about that are being bought down are permanent buy downs, correct?
right. Right.
Yeah.
Yeah. I'm not a fan. That's a whole nother show about why I'm not a fan of the temporary rate buy downs.
Here we are now with a permanent rate down buy down. So if you end up with the rates in the low fives, you may not have to refinance anytime
Sure.
soon either, which is great. That also saves you money down the road. Well, great, Brian. Appreciate your time, and as always, we'll look forward to the next time when we have a fantastic update for you guys.
Sounds great. Thanks for having me.
All right, a little rusty, but
It's good.
we'll
We'll
get
get
there.
some out of
Magic of editing. Won't realize what kind of ass clown I am. Anyway.
it.